The problem with Iran is every time they make a deal, the people that are in charge there, they either break it or they want to change it. So it looks like they're not ready to make a deal. So they're going to continue to pay a price. And every night the price gets higher and higher and higher.
Hello and welcome to the Week Ahead on Nomura podcast. My name is Zubin Paracuelas, Chief Southeast Asia Economist at Nomura in Singapore, and today is Friday, the 24th of July. The risk-off tone is persisting across global financial markets as re-escalating Middle East tensions, surging oil prices with Brent crude touching $100 yesterday, and renewed inflation concerns all dampened investor sentiment. Bond yields moved higher and lifted the US dollar with it, while equity markets struggled under the combined pressure of resurgent energy prices and some disappointment in tech earnings. The US strikes on Iran has continued for a 13th day in a row, and comments from US officials suggested limited signs of a deal so far, as you heard in that clip from Secretary of State Rubio, who happens to be visiting Southeast Asia at the moment. Meanwhile, trade tensions are back in the headlines with the announcement of new U.S. tariffs of between 10 to 12.5% for 60 trading partners. The ECB kept its policy rate unchanged as widely expected, and this could be a prelude to what will likely be on-hold decisions by a few central banks in the week ahead, including the Fed and the BOJ. The comments will be interesting to watch to gauge how these central banks deal with rising uncertainty. To discuss all of that and more, I'm joined by Aichi Amemiya, our senior U.S. economist in New York, George Buckley, chief economist for Euro area and the UK, and Yuichiro Nusaki from our economics team in Tokyo. We also have a special segment in this episode, and I'm very pleased to say that Vijay Sundaram, our global head of front office risk and control for our wholesale businesses at Nomura, could spend some time with us. He provides his thoughts about various market risks that are keeping him busy, which is obviously a very timely topic in the current environment. So don't miss that at the end. Now let's dive in. Okay, let's kick off with the US. Hi, Aichi-san. Really great to have you on the podcast. I can't believe this is only your first time here. But thanks for joining, especially in this period where there's plenty of things happening.
Yeah. Hey, Yuben. Thanks for having me. Yeah. So there are a lot of things that are happening in the US, indeed.
Yeah. So I guess the big one really is for the week ahead next week. We've got the FOMC. The second one under Chair Warsh. And if I remember correctly, the first one, the Fed managed to out-hawk market expectations. So what do you expect this time on the policy decision?
So in terms of policy decision, we expect the FOMC to stay on hold, keeping the current level of policy rate at the current level of 3.625%. So, of course, there's some people speculate some potential hawkish surprise. Of course, the surprise is a new feature of the Warsh's Fed. So Warsh thinks that the surprise is a good, effective way to control the market expectations as opposed to providing the forward guidance. That said, based on our, read of his recent comments, Warsh is inherently dovish, and also given the weak CPI number last week. All incoming information point to, the no rate hike in the near term. So that's why we are comfortable with our expectation or no hike next week. Yeah.
Yeah, and then of course, that's also our forecast for the rest of the year at this point, right? There's no rate hikes by the Fed at all. Okay, and speaking about Warsh, you've talked a bit about it earlier. What do you expect from any comments at the press conference or his tone? Yeah, maybe is that where we can probably get some fireworks again?
So probably Warsh will likely stick to his own, the communication strategy, which means that he's unlikely to provide clear, explicit forward guidance for the near-term policy outlook. So it's pretty tough to glean any, clear implication from his press conference. That being said, his recent testimonies and public appearance, they suggest that he is, inherently dovish. So, for instance, he said that AI is ultimately disinflationary, and also the recent emerging price pressure from AI investment boom will likely be temporary. And also, he recently mentioned that existing inflation data are not so reliable, and then deferring to the future work by the federal task forces on the data and inflation frameworks. So it's likely, for him to defer to the future work from the, five Fed task forces, and then without giving any strong his personal view, especially in the hawkish side. So that's my view, and then possibly like his recent comments, we could hear some dovish bias from his comments, but again, it's pretty unlikely for him to give a clear, explicit, comments on the near-term policy outlook.
Yeah, and I guess you mentioned the five task force. Just a quick follow up. They are still scheduled to give their recommendations. I guess targeting year end, right? So not much he can say before that.
Yeah, so initially he said that the five task forces will likely conclude by the year end, and then in a separate the speech comments he said that it could take 6 to 9 months. So the timeline is a little bit ambiguous, but we could see, but for sure that the task forces are unlikely to reach a conclusion before the midterm elections in November, which is the political calendar is also important given the recent pressure from the White House on the Fed. So but anyway, we could see the task forces reach conclusion by the year end or maybe early next year. So that's the timeline.
Okay, yeah, got it. That's clear. And finally, Aishi-san, so shortly after the Fed, we also have the release of the core PCE data for June. What do you expect there?
So we expect a 0.175% month-on-month for June core PC inflation, or the 0.2% on rounded basis, down from 0.3% in May. So which is an encouraging sign for the Fed. In terms of year-over-year, so we expect year-over-year core PC inflation the inch lower to 3.3%, down from 3.4% in May. So probably year-over-year core PC inflation is peaking now, and then we expect some gradual moderation during the second half of this year because of modulating wage growth and also waning impact from tariffs. Also, there are some couple of technical factors to support our view of a more gradual modulation of core PC inflation over the next 6 months. One is a BEA statistical agency is planning to do some methodology changes to the certain key PCE components, which will likely reduce year-over-year core PC inflation by about 20 basis points, which is important. And also, the other technical factor is a negative residual seasonality, which means the month-on-month core PC inflation tends to be weak during the second half of this year. So for those reasons, we are comfortable with our expectation of modulating your core PC inflation during the next 6 months.
Okay, yeah, that's brilliant. Thank you very much, Aichi-san. Hope to have you back again soon.
Thank you very much.
Okay, let's swing over to London. Hey, George, welcome back to the podcast. It's been an eventful week or two for you, particularly in the UK.
It has indeed. You've been lots to talk about.
But before that, let's start with the ECB, which just announced its decision as we record this. Any quick thoughts on that, please?
I mean, from what she said, Lagarde, the president of the ECB, did not really seem to give us any clear hints about where things are going. One thing she did say is that it sounded like they were teeing up September as best they can without wanting to give any forward guidance. So I do think that sort of supports our view that the ECB will raise interest rates in September, and especially if oil prices continue on the trajectory that they have been doing. They did say in the statement that there's more to come on inflation. We know that because, of course, in their last forecast round, they told us that inflation wasn't going to peak in core terms until the start of 2027. So we knew that anyway. But by building that into the statement and telling us that they'll be watching the data very carefully over the next month does suggest that September seems very likely for the next hike.
Okay, interesting. And speaking of inflation, we've got the euro area numbers coming out next week as well. What are you expecting from there?
Well, we do, and I think they'll be very interesting and useful for the ECB. As Lagarde said, there's quite a lot of data coming out between now and that meeting. So we have the inflation numbers for July. We will also have the inflation numbers for August. So it's not just next week's numbers, but also the month afterwards as well. We get quite a lot of double data over the next month. So that's why next week's figures on inflation, euro area inflation, and also all of the other data is going to be very important. There's a lot of it, and it will give them a much better sense and chance to assess all of that when it comes to the September decision.
Okay, got it. Now, going to the UK, we've got the Bank of England as well next week. What is your forecast on the policy rate, and what else are you watching that might change, whether it's a forward guidance or the vote split, and especially taking into account the resurgence in energy prices from the re-escalation of the war in Iran?
Well, yeah, and the Bank of England does have a lot to speak about next week because, of course, it's not just a normal monetary policy meeting, it's a monetary policy report meeting where they publish their new forecasts. So there's that. So look out for what they say about where inflation might settle. I suspect that the inflation outlook in the near term is going to be revised down because we've had a couple of downside surprises in April and May. But where does inflation settle? How long does it take to get inflation back to the 2% mark? And will they provide these scenarios like they did last time? There was no central view. It was all based on 3 scenarios. But other things to look out for, of course, is as you say, the official guidance. I don't think any central bank, we've seen the ECB this week, the Fed too, and also the Bank of England, none of them really fancy providing much forward guidance in this sort of environment where they simply don't know where things are going because of the Middle Eastern energy. The voting pattern, I imagine, is going to be 7-2, 7 voting for unchanged rates and 2 still voting for a hike. So probably no change there. But those are the interesting things for next week. But I'm not sure we're going to see any change in rates. And in fact, we don't have any rate hike in our profile. That might have to change if oil prices continue on the path that we've seen them move. So it's obviously an upside risk to our forecast. But at the moment, the next move we have in UK rates is down in the second half of next year of 2027. But let's see where oil prices go.
Okay, yeah. So it sounds like nothing much there, except that there's quite a few things that they are still looking out for, given the uncertainty. And finally, George, there's been a lot of things as well on the political front. There's a new prime minister, and what has been the latest on that, I guess is my question, particularly on his new government fiscal plans and any implications you're seeing from those comments so far.
Well, I mean, the markets have had a bit of an up and down week, really, in terms of what's been said so far from the new Prime Minister, Andy Burnham. One thing which has been a positive side has been the announcement of the Chancellor. The Finance Minister of the UK is going to be John Healey, who is relatively centrist, but he did have sizable ambitions when it came to defence spending. Don't forget, he was one of the last ministers to resign from Starmer's cabinet because he wasn't getting enough money for defence. He was the defence secretary in the last administration. So he could be pushing for higher spending for defence and maybe other things as well. The question is where they're going to get it from. There isn't much leeway in the public finances and the fiscal rules. Yet that's exactly what Andy Burnham has said he wants to do, which is to extract as much flexibility as he can in the fiscal rules, which is interesting because there isn't much flexibility. One thing he could do is to potentially increase the level of debt by not impacting the flow rule, the deficit rule. And the way to do that would be to focus on investment, because the flow rule, the deficit rule, does not include investment. The only problem, of course, with that is that if you borrow a load more money, it means that you have to pay interest on a load more money, especially if your interest rates and yields go up. So there is a risk that by raising the amount of debt that the government has, you are also impacting the deficit rule as well. So there are lots of things to think about. The market has been a little bit nervous about that comment about the flexibility in the finances. So I think it's a case of watch, wait and see. But the one thing he's been trying to do is for every policy he's been announcing, and they're not very big so far, but every policy he's announced, he's tried to say he's going to look for the funding for it and identified specific areas where that funding would come from. So in other words, for example, one thing he said was to reduce the rate of VAT on electricity bills. It didn't cost very much, but he said that he was going to get it by scrapping ID cards. Lots of challenges about that, but the point is he's trying to say we have places where we can fund this from, even though it's not very big. The last point I just wanted to make, Euban, is that it's really going to be the budget, probably in October sometime, that is going to tell us just what they're made of, where they're going to focus their efforts in terms of fiscal priorities.
Okay, sounds like still a lot of moving parts until we get to that budget in October. Okay, fantastic. Thanks very much, George.
Thank you, Euban.
Now, moving to Japan, I'm joined by Nozaki-san from our economics team in Tokyo. Hey, Nozaki-san, thanks again for joining.
Hi, Yuven. Thanks for having me.
Yeah, great. Yeah, we have a interesting week ahead with the BOJ. So what are the key points you're watching in the BOJ policy meeting on July 30 and 31st?
First, we expect the BOJ to keep the policy rate unchanged at 1%. The BOJ just raised rates in June, and it is now in a phase of assessing the effects. That said, there is a possibility that one or two hawkish board members will argue for consecutive rate hikes. This time, the BOJ will also release its quarterly outlook report. Compared with the previous April forecast, we expect the CPI outlook for fiscal 2026 to revise downward, reflecting factors such as the decline in crude oil prices, while the GDP growth forecast is likely to be revised upward. Even if the inflation outlook is revised down, the broader picture remains unchanged. Inflation is expected to rise, and the risk is skewed to the upside. The bank is likely to maintain its stance of continuing to raise the rate.
Okay, so it sounds like still a pretty clear signal from the BOJ in terms of the path ahead. What about the press conference? What do you think the Governor Ueda will say?
At the press conference after the meeting, Ueda is unlikely to give any specific hint about the timing of the next rate hike. However, on Wednesday evening this week, several media outlets also reported on the possibility that the Bank of Japan may accelerate the pace of interest rate hikes. It will be interesting to see to what extent Ueda will make remarks that suggest an earlier rate hike. Our base scenario remains at a rate hike in December. In addition, the government's basic policy determined this week has made the BOJ's independence a major market topic. Naturally, reporters will ask Ueda about it. We will be watching closely not just for a standard response about the need for close communication, but also for any remarks that suggest the governor's commitment to the BOJ's independence and to price stability.
Okay, yeah, a lot of couple of interesting things to watch as well in the press conference. Away from the BOJ, any other data releases you're watching next week? I understand there's a Tokyo CPI, which again could also have an impact on monetary policy.
On Friday, July 31, Tokyo CPI for July will be released. We expect core CPI inflation excluding fresh food to accelerate slightly to 1.8% year-on-year from 1.7% in the previous month. Until June, CPI had shown little impact from higher crude oil prices, but starting in July, food price increases have been coming one after another, reflecting higher packaging and transportation costs. We are watching closely to see whether the effects of higher crude oil price will finally begin to appear in consumer prices as well. The BOJ appears to be paying close attention to this summer's price pass-through based on the information gathered through its regional branches and other channels. Trends in price pass-through during the summer will be an important checkpoint for thinking about the outlook for inflation and monetary policy.
Yeah, great. Yeah, the interesting point you made about food inflation, adjusting higher. We've seen that in other countries too. I mean, today we just had the Singapore CPI print, and yeah, it's been stable for the last couple of months, but it's finally picked up. So again, to your point, could be starting to reflect some of the impact of the energy price shock. Let's leave it here. Thanks very much, Nozaki-san.
Thanks.
Let's do a quick roundup of what's in store for the rest of Asia. We have Singapore's monetary policy statement on Monday, the 27th of July, and our FX strategy team expects the MES to leave its FX policy unchanged, although it is a very close call. A key reason to pause will be MES taking a wait-and-see approach, given higher uncertainty, including in the AI CAPEX cycle, which might be seen as a growth headwind. On the other hand, upside risk to inflation with oil prices resurging and the output gap remaining positive could also make it possible for MES to tighten. In China, we expect the official manufacturing PMI to drop to 49.8 in July from 50.3 in June, reflecting sustained weakness in domestic demand, as well as some supply chain disruptions in upstream sectors. In Taiwan, we expect GDP growth to remain solid at 10.9% year on year in the second quarter after rising to 14.5 in Q1 due to stronger domestic investment growth owing to the AI boom. In Australia, we forecast a 0.2 month-on-month increase in the June CPI. Markets will also be focused on the June quarter trim mean CPI, and we expect this to rise by 0.9% Q&Q, although slightly below the RBA's forecast within its May quarterly statement. And finally, for our special segment, I'm very delighted to be joined by Vijay Sundaram, who is our global head of front office risk based in New York. It's great that he could be with us. It's a very timely topic, talking about risks and uncertainty, whether it's geopolitics or AI, that global financial markets have to deal with. Hey, Vijay, welcome to the podcast, and thanks very much for your time. Perhaps we can start with a bit of an intro of your role at Nomura. What is it exactly that you're looking at? And also with what's happening these days where there's a lot more uncertainty, how has your approach to risk management changed?
Yeah, so front office risk is a global in-business function that aims to ensure all the risks we take in our wholesale business are identified, assessed, and managed in line with the firm's risk appetite and our return targets. So as you say, uncertainty seems to be the only certainty these days. We seem to get material risk events at least once a year. This year we have the US-Iran war, we had Liberation Day tariffs last year, the collapse of Silicon Valley Bank in 2023, and a credit market dislocation in 2022. In such volatile markets, there are a few imperatives for us. Firstly, we need to be very quick at gathering all relevant information so our decision-making is not delayed. Generally, trading profiles and counterparty risks are readily available, but there are less obvious areas like our collateral and where it resides, legal agreements, settlement risks, and so on, which are equally important. Secondly, a lot of our risk analysis is around market scenarios that can significantly impact our business. We try to model a range of extreme but plausible scenarios to identify where the potential flashpoints could be and where we could be vulnerable. In a market event, we have to be quicker, more detailed, and more frequent, as things can change intraday or even by the minute. Thirdly, we have to look holistically across all types of risks as these are linked. A market disruption clearly directly affects our trading books and our clients. But you may also see much higher transaction volumes, which can create operational or system risks. And funding and liquidity of markets or key products may be impacted too. And finally, as a firm, our communication and escalation of issues has to be rapid and lucid. There are many risks to consider, but filtering it to the top 3 to 5 that really matter is crucial.
Great. Thanks for that very clear intro, Vijay. And seems like speed is important based on what you said in dealing with these risks. But you also mentioned there's all types of risks. But what would you say would be the risk that would be considered front and center?
Yeah, so I think today we have a confluence of several risks. Firstly, the restart of war hostilities and some differences in energy markets from the initial phases in March and April. As I speak, front month Brent is around $98 and has retraced more than 60% of the decline we saw in May and June from a peak of $118. But more concerningly, we have refined products like distillates, gasoline, and diesel at levels we haven't seen since the mid-1970s. Similarly, European natural gas is actually above the March peak. And these products have a more direct impact on consumers and companies than crude oil itself. You also have oil inventories at very low levels, US refinery capacity running at a very high 96%, a potential new oil blockade in the Red Sea, and we are in peak driving season in the Northern Hemisphere, unlike the start of the war, which was during the spring shoulder season. So the risks are rising that we see a more material spillover from energy to other products and markets if there is continued impasse between US and Iran, and especially if we see an escalation like bombing of energy infrastructure. A second primary risk is significant uncertainty in the path of central banks and the real possibility that G7 interest rates break out of their recent ranges significantly. So we have risen to the top of the 3-month range in US, Germany, and Japan in the mid to long-term end of rates. And we face the inflationary impact of energy and its knock-on to other products, the return of tariffs, rising IT costs for corporations from AI-related spend, a still robust US consumer, and ever-increasing deficits. Now, history tells us that both the level and the speed of increase of interest rates matters. If, for instance, the 10-year US rates moves quickly above and beyond 5%, risk assets like equities, credit, mortgages, and so on could be very vulnerable. And thirdly, we have the risk of a major correction in technology and AI. Now, this has been a hot topic, and we see some changes emerging in how the market is reacting to AI capex spend. Several large debt issuances have not been well received. Oracle was one of the first, and more recently we had Amazon and several data center companies had to scrap their issuances. There are also clear signs that the market is increasingly looking at return on investment and return on free cash flow of hyperscale companies rather than just capex spend amounts alone. Google earnings this week was another example of this. And then there are clear cybersecurity risks that the private sector, governments, and regulators will need to address. All in all, there is a shift in how the market is digesting new information and potentially elevated risks in this space.
Okay, got it. So geopolitics and AI, but also I found it striking in terms of what you said about rising interest rates. And yeah, as we spoke earlier in the podcast, we've got the FOMC next week, and obviously all eyes on that as well. And then the BOJ. And what about those risks that may look peripheral, but are important to watch, and risks that are also emerging?
Yeah, as a risk manager, emerging risks can be the most dangerous. There are several on our radar, and let me highlight a few. Firstly, leveraged ETFs. There has been a massive growth over the past few years. Since 2020, the number of leveraged ETF funds has doubled, and assets under management grew from 50 billion to a recent peak of 300 billion before a recent pullback. And since these funds are mostly 2 or 3 times levered, the total market value of holdings reached a peak of 750 billion. Many of these ETFs are on technology stocks, particularly semiconductor chip names. Now, when the underlying stocks for these funds move, the funds have to buy or sell large amounts to rebalance their leverage. And this is exacerbated by inflows and outflows to the funds from investors who are almost all retail. The net result is market volatility in the tech, semiconductor, and AI sector has increased both on the upside and downside. In particular, we've seen big swings in the Korean Kospi Index, where we have leveraged ETFs on 2 of the most prominent chip names, Samsung and SK Hynix. Now, I don't see leveraged ETFs by themselves causing a market event, but they can be an important transmission mechanism that can turn a moderate downturn into something larger and correlated across the globe. Secondly, private credit. Now, this was quite prominent late last and early this year when we had some buy-side and sell-side losses from names like First Brands, Tricolor, and some others. A number of private credit funds had to restrict investor redemptions in this period. Now, private credit has rather faded from risk prominence over the past few months, in part due to matters like the war and AI, but also because growth and earnings, especially in the US, have been quite robust and public credit markets have been liquid and well supported. But we don't think the risks have vanished. If we get a confluence of some of the other risks I mentioned, like a rapid increase in interest rates, a major equity technology correction, and continued escalation of Middle East hostilities, then we think the credit space could be quite vulnerable. Now, credit spreads are very tight currently, and pricing of private credit tends to be less transparent. So once things start to move, the impact could be quite deep. Thirdly, there is funding. Now, generally over the past few years, funding has been quite good, even during the COVID crisis when central banks added a large amount of liquidity and augmented funding facilities. However, in the past few months, we saw a dramatic tightening in interbank funding of equity assets, driven significantly by the rapid increase in markets and demand for assets, especially tech-related. Now, this has eased a bit in the past few weeks, but year-end funding remains significantly elevated. So far, this has not spilled over into other markets like fixed income repo, but it is something we are watching. And finally, I want to mention crowding. We are seeing an increasing tendency for market players on both the sell and buy side to become concentrated in similar trades. Now, this has always been a risk in financial markets, but the growth in assets and the footprint of the larger players is making this a bigger factor. The impact of this is when sentiment changes, you can get a large amount of capital trying to exit a trading strategy at the same time, rather like a big crowd of people trying to get through a narrow doorway. Now, we saw this in the JGB market after Liberation Day last year and in the European and UK government markets in March. On each occasion, we saw 8 to 10 standard deviation moves in those markets, which is massive. So this is something we continually watch. If we start to see a larger or more correlated reaction to news, it is often a sign that a trading strategy has become more crowded, and we need to be more careful as a result.
Yeah, fantastic. Thanks, Vijay, for giving us a comprehensive list of those things that we need to be watching out for, especially those that seem to be under the radar at the moment. Yeah, we'll have to leave it there. And again, thank you and hope to have you back again soon.
My pleasure, Euban. Thank you very much.
Well, that's it for now. Thank you again for listening to our podcast, edited and produced by John Dalton. Please like and subscribe to Nomura's podcast from your usual provider. We'd love to hear your feedback, so please feel free to write a review. And please share this podcast to anyone you think might be interested. You can check out NomuraConnects.com for more of our research and updates. Have a great week ahead.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice nor is legal, regulatory, accounting or tax advice and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomuraconnects.com.